While everyone's obsessing over Bitcoin's next move, ETF inflows, and which altcoin is going to 10x this cycle, Japan just quietly lit the fuse on what could be the biggest forced liquidation event in modern financial history. We're talking $2 trillion in borrowed money, sitting in global stocks, bonds, and yes, crypto, that could unwind almost overnight. It's called the reverse carry trade, and right now, it's accelerating. This is the macro story your portfolio needs you to understand before the market explains it the hard way. For almost 3 decades, Japan ran the world's most generous carry trade. Here's how it worked. Japan kept interest rates at basically zero, sometimes even negative. So global investors and hedge funds did something obvious. They borrowed massive amounts of yen, converted it into dollars or euros, and poured that money into higher yielding assets. US stocks, emerging market bonds, real estate, and eventually, crypto. Why not? The borrowing cost was nearly free. The returns on the other side were not. At its peak, this trade funded somewhere between $500 billion and $2 trillion worth of global asset positions. That's not a rounding error. That is the hidden fuel behind a decade of bull markets. And for years, it worked perfectly. Yen stayed weak. Rates stayed low. The machine kept printing, but machines break. The Bank of Japan, the BOJ, has been slowly, carefully hiking rates for the first time in a generation. As of April 28, 2026, the BOJ held its short-term rate at 0.75%. That might sound small, but that's the highest rate Japan has seen since 1995, and the vote wasn't even unanimous. 3 out of 9 board members pushed for an immediate jump to 1.0%. The hawkish pressure is building. Here's what's driving it. Japan's core inflation forecast for fiscal year 2026 just got revised up to 2.8%, up from 1.9% just months ago. A huge revision, and a lot of that is coming from energy. Japan imports over 90% of its crude oil, and a significant portion of that oil moves through the Strait of Hormuz, a choke point that's currently under serious geopolitical stress. When energy costs spike, they spike in Japan harder than almost anywhere else on Earth. So the BOJ has no choice but to keep tightening. Meanwhile, the 10-year Japanese government bond yield just hit 2.52%, a 30-year high. That's the rate at which yen-denominated borrowing becomes genuinely expensive for the first time since the 1990s. When borrowing, yen stops being free, the carry trade stops making sense. And when it stops making sense, it unwinds. So what actually happens when the carry trade reverses? Think of it like a global margin call. Traders who borrowed yen now need to buy yen back to repay their loans. But the yen has been strengthening, meaning every dollar they used to buy assets now buys fewer yen. Their cost basis is rising. Their window is closing. So they sell. They sell US treasuries. They sell stocks. They sell anything liquid enough to convert back into yen fast. That forced selling hits markets that have nothing to do with Japan. It's not about fundamentals. It's not about earnings or adoption. It's purely mechanical liquidation, and it doesn't care what you own. We've seen versions of this before. 2008, 2015, August 2024. Each time, markets dropped sharply, correlations spiked, and the phrase carry trade unwind trended on financial Twitter for about 48 hours before everyone forgot again. The difference now, the trade is bigger than it's ever been. The BOJ has been ultra loose for longer than ever, and we have a simultaneous oil shock, geopolitical risk, and a global economy already under pressure. Analysts at BCA Research and UBS have called it a ticking time bomb. The fuse is lit. We don't know the length. Crypto is a high beta risk asset. That's finance speak for when risk appetite collapses, crypto gets hit harder. than almost anything else. Here's the brutal reality. During carry trade unwinds, Bitcoin doesn't need bad crypto news to dump. It just needs USD to JPY to move fast. When the yen strengthens, even a few percent, leveraged positions across every market start getting margin called simultaneously. And the first thing institutions sell when they need liquidity fast is their most volatile, most liquid holdings. That's Bitcoin. That's Ethereum. We've seen BTC drop 10 to 20% on what looked like a nothing happened news day, only to discover days later that a yen move triggered a broader deleveraging wave. ETH tends to follow, and often worse, because of the leveraged DeFi exposure sitting on top of it. Now, here's where it gets interesting for XRP holders. There's a growing narrative in the crypto community and some analyst circles that XRP could actually benefit from this chaos. The logic: Japan's massive cross-border repatriation flows need fast, low-cost FX settlement. Ripple's on-demand liquidity product is literally designed for JPY to USD conversions without pre-funded accounts. If the reverse carry trade forces trillions in cross-border flows to settle in real time, and institutions start using XRP's rails to do it, you'd see genuine utility-driven volume, not speculation. That's speculative for now, but it's the kind of narrative worth watching. If it starts showing up in actual ODL volume data, it changes the story. Here's the uncomfortable truth that most mainstream financial media won't say plainly. A significant portion of global asset price inflation over the last decade, stocks, bonds, real estate, and yes, crypto, was quietly funded by cheap Japanese money. Not because Japanese people were buying your Ethereum, but because global institutions were borrowing yen at near zero rates and parking that capital in everything else. It created a constant, invisible bid under risk assets. That bid is being removed. As the BOJ normalizes, as JGB yields rise, as yen repatriation accelerates, that hidden fuel drains out of the global system. What's left has to stand on its own fundamentals. For crypto, that's actually a long-term test worth passing. Bitcoin's fixed supply, borderless settlement, and zero dependency on central bank policy are exactly what a deleveraging world needs as an alternative. But short-term, the forced selling doesn't care about your thesis. It just sells. The investors who survive this are the ones who understand the macro current they're swimming in and position accordingly. So here's where we are. The Bank of Japan is hiking. JGB yields are at 30-year highs. The yen carry trade, $2 trillion of hidden global leverage, is under pressure like never before. And crypto, as always, will feel the shockwaves before most other markets do. This isn't a prediction of doom, it's a map. And the people with maps don't panic. They prepare. If this video gave you a clearer picture of what's actually moving markets right now, drop a like. It tells the algorithm this kind of deep macro content is worth showing people. Subscribe if you want the next one, before your portfolio figures it out the hard way. And if you want to go deeper on how BOJ policy affects Bitcoin specifically, that video is coming. Make sure you're here for it. See you next time.